What is up, everybody? Welcome back to another episode of Bitcoin and Markets. Hope you guys are doing well. Happy Friday. I did not do a live stream on Wednesday, but did a weekly roundup on Monday. So you guys can go back and check out that. I have been writing a lot this week. I put out a blog post. I'll just share my screen and get right into it. We're going to go over tons of stuff today. It's kind of a grab bag of stuff in Bitcoin and macro. But here's an example of the stuff I've been writing. This is talking about business cycles. I wanted to respond to something that Tuur Demeester tweeted out, and a post that he wrote, a paper that he wrote back in 2016, and he was just tweeting about it recently. But I don't agree with the typical business cycle stuff. Okay, and is all in good faith. I mean, I highly respect Tuur. I'm not digging into this. This is very clear-cut Austrian view of recession and of the business cycle, but I had to add my 2 cents. So anyway, that went out to paid subscribers first, and then it will also be made public here probably by the end of the weekend. So check out bitcoinandmarkets.com for all my stuff. You can sign up for the free weekly newsletter with the free tier. You can support me there, and that's where if you support me monetarily, that's when you could get first access to the stuff that I come out with. Also, I don't have this pulled up, but I will pull it up right now. bmpro.substack.com came out with 2 posts. So Bitcoin ETF inflows in context. I wanted to talk about that today as well too. We're going to watch a quick little video from Fred Krueger on Twitter, and he talks about this. I made my own little table here and talk about this, all the different flows, talk about watching the blockchain, because, if we have to rely on TradFi, right? And TradFi has done a horrible job keeping us up to date on the inflows, and the volumes are okay, but not the inflows, the buying and selling of the Bitcoin. But we can watch that on the blockchain. So that's pretty amazing that we can do that with Bitcoin. Only asset in the world that we can do that with. And talk about at the end here, massive buying pressure in context. So 200 million a day on average. Saylor is trying to get 200 million, and Tether, they added at Q4, I believe they added $380 million to their balance sheet. So that is those type of big events that used to be the really big events for Bitcoin demand. Those are happening every day with the ETF. So it's just going to be a matter of time before that starts having an impact. Okay. And also I came out with a mining dashboard. We come out with these market dashboard and a mining dashboard every week. So if you guys are interested, you can go over and check out bmpro.substack.com. All right. Like I said, it's going to be kind of a grab bag of stuff today. Let's start off with Fred Krueger. And I'm going to stop sharing, and reshare, make sure I'm sharing my system audio, and pick the right tweet. Shifting all over here today. But all right. Oh, and guys, if you're watching on YouTube or Rumble, comment down below. Same with Telegram, comment in the post for this live stream. I'll get to the comments later on. And all right, let's roll into it. Let's go.
Good morning. Episode 23, Thursday, January 18th. Bitcoin's at 42,600. In this episode, we're going to focus on quantitatively the selling of GBTC and the buying in these other non-GBTC ETFs. So what do we know? We know that currently GBTC has 592,000 Bitcoin. But we also know that it started the year with 619,000 Bitcoin. So it has lost quite a few Bitcoin since the beginning of the year. And we can even go back further. And in a recent tweet, I showed that GBTC was losing about 300 Bitcoin per day in Q4 of last year. So it went from 622,000 Bitcoin to 619,000 Bitcoin, a loss of about 3,000 Bitcoin in a period of 90 days. So it lost 300 Bitcoin per day, which is substantial. Now, that loss has accelerated to about 10,000 Bitcoin a day over the last 3-4 days. And that's showing no sign of slowing right now. So we're we have this massive selling coming out of GBTC. And why selling? Well, for the first time, the discount is not -5%, it's zero, right? So effectively 0.5 right now. So GBTC is now, the spread's collapsed, the selling has just accelerated, and as we're going to show, about half the selling is being recycled now into the new ETFs. So where are the new ETFs? Well, Thomas from Hey Apollo has this great tool that's still being worked.
Okay, it's a little bit unclear what he said there. So half of GBTC selling is being recycled. No, I think it's the other way around. It's all of GBTC selling is being recycled. Let's go back to my table. Share this tab. So we see inflows here. Total inflows, including GBTC selling, is still over $1 billion. All right, so Bitcoin is absorbing, or the ETFs are absorbing all of GBTC's outflows. So it's not, maybe he meant the other way, like half of the buying of ETFs is being, provided by GBTC selling. That's closer to reality, but that's not what my numbers are showing. I mean, maybe he's talking about right now, today, you have, he's including Friday. I'm not including Friday on my numbers here, but we've had 2 negative days, but we've had 3 positive days. So anyways, okay, let's go back to the video.
But it's getting better every day. And this tool will allow you to easily check the ETF flows. And we can see that as of yesterday, there was a total now of 643,000 Bitcoin into these new trusts. So we've actually increased 24,000 Bitcoin from the ETF. So if you're wondering, was it net selling, net buying? There definitely was net buying, and the buying was about 24,000. However, the total buying into these new ETFs was more like 46,000. So roughly half of the new ETF volume is coming from GBTC selling. So James Seifert had estimated at greater than 30%, and I can now further quantify that as saying it's 47% as of right now. So with that behind us, now where does that leave us? Well, it leaves us that we're still net 20,000 plus in 3 or 4 days. So I'm going to quantify that because the GBTC flows are T+2, the other flows are T+1, so it's a little messy. But let's just say on average right now we are adding.
But I don't think it has to be T+2. So T+ means that they have 2 calendar days, or is it business days? They have 2 days to get those Bitcoins to back their ETF. One, I mean, that's kind of slow, obviously, if we're in Bitcoin and we think of, just seeing the transparency of the blockchain right there. But I remember a discussion where the space was having, the community was having back, I want to say it was like 2015 or 16, and the blockchain, all the things meme was really getting going. And we had R3 was a big a blockchain company. They were going to put everything on the blockchain or make a blockchain for everything. And they had a consortium of banks that were joining this. It's like 40 banks joined this consortium to work on blockchain technology back then. And most of the information that came out of that time, because they were like, oh, we can take the T+3 or whatever it is for settlement of stocks down to T+0 with this technology. And the response was, we don't want that. They want to have a little bit of float. That's how the old system works. They skim a little bit, It's like the Office Space movie where they are just rounding up, or they round down the penny and take that fraction of a penny into a different account. That's kind of what they're doing with the float, and why they want this T+3 or T+2 or whatever the case is. The old system wants that. It's kind of like a rent seeking. So anyway, I don't know why I got on that topic, but that is TradFi for you. Okay, Bitcoin is taking over traditional finance.
5,000 Bitcoin per day net buying pressure on average. And just to quantify that, that's 10 times the effect the halving is going to have in mid-April, about 100 days from today. So the halving is only 450 Bitcoin per day quantitatively in buy pressure, and this is more like 5,000 Bitcoin per day. So that's kind of the end of the quantitative discussion. I think that this is understood right now. I'm going to focus now on the overall net number and the net number in the new ETF. So what is 640,000 Bitcoin? Well, one way to think of it is 3% now of all Bitcoin that will ever be created is now sitting in these ETFs, and that number is rising. So we have this new number, 3%, that's in all the ETFs.
Holy cow! So 3% already is in the ETFs of all Bitcoins. If Bitcoin price does not go up dramatically in the next, say, 90 days, that could go above 5%. That could be 8%, 10%. Because the inflows are going to keep coming. But, if you have, so let me rewind a little bit to what he said there, that this is taking about 5,000 Bitcoins off of the market every day. And that's 10 times the effect of the halving. But, the halving is Bitcoin based and the ETF flows are dollar based. So if the ETF flows keep coming in at 200 million a day, which is about what they're averaging, a little bit over 200 million a day, that's going to buy less and less Bitcoin, right? So that 5,000 effect is not, that can turn into 1,000. And it will eventually, those flows might go lower too. So it might be a 100 million a day or 50 million a day. And that's going to buy less and less Bitcoin as the price of Bitcoin goes up. However, the effect of the halving is Bitcoin determined. So 450 Bitcoins per day, 450 fewer Bitcoins per day. The effect of that is going to increase. That effect increases as the price goes up, where the effect of the ETF demand decreases as price goes up. But anyway, the price has to go up or these ETFs are going to buy 10% of all Bitcoins in relatively short period. It's been 6 days and they already have 3%. We got to go. It's got to go up, guys. This is going to suck all of the Bitcoin out of the world, which is not a bad thing. It's a good thing, but I don't really want 10% of all Bitcoins in the ETF.
ETFs. And where are we going to close out this year? I think we're going to close this year out more like 5% of all Bitcoin's going to be in the ETFs, or something like 1 million Bitcoin.
Okay, so he said 3% of all Bitcoin is already in the ETFs, but by the end of the year, it's only going to be 5? That doesn't square. It's been 6 days.
Which is what David Bailey from Bitcoin Magazine thinks. So 3% is nothing to sneeze at. And the share of the non-Bitcoin ETFs, which in just 3 days has hit 0.25%, which is astounding that, 0.25% of kind of the future world money supply. If you believe like me that, Bitcoin is the future of money, that is now an ETF. So
what was I getting wrong? So now he says 0.25%. Let me rewind this, see what he says.
Per day, quantitatively in buy pressure, and this is more like 5,000 Bitcoin per day. So that's kind of the end of the quantitative discussion. I think that this is understood right now. I'm going to focus now on the overall net number and the net number in the new ETF. So what is 640,000 Bitcoin? Well, one way to think of it is 3% now of all Bitcoin that will ever be created is now sitting in these ETFs.
Yeah, that's what he said.
And that number is rising. So we have this new number, 3%. That's in all the ETFs. And where are we going to close out this year? I think we're going to close this year out more like 5% of all Bitcoin's going to be in the ETFs.
Okay, because that's coming from GBTC, and he's saying people are selling GBTC. But yeah, I see what he's saying.
Or something like 1 million Bitcoin, which is what David Bailey from Bitcoin Magazine thinks. So 3% is nothing to sneeze at. And the share of the non-Bitcoin ETFs, which in just 3 days has hit 0.25%, which is astounding that, 0.25% of kind of the future world money supply. If you believe like me that, Bitcoin is the future of money, that is now an ETF. So I think it's just mind boggling that the ETFs are really taking over the world like this. It's just going to be a increasing flow up. And when you sort of think about it in those terms that, we're at 3% of Bitcoin supplies an ETF, and that number is going to get to 5% by the end of the year. I think there's no reason to be anything less than very, very bullish on Bitcoin and on these ETFs. The last thing I just would say is GBTC now has come out with their new branding, which is it's pretty slick.
Okay, that's all he had to say about that. I wanted to look up Eric Balkunis because he had a good tweet here today that someone shared on the Telegram. Where is it? Come on, buddy. Here we go. The fastest ETFs to get to 1 billion in assets out of all 5,000 ETFs that have ever launched. I mean, I'm guessing this is the United States, or maybe it's the world. I don't know. But number one is the Bitcoin futures ETF, BITO. That got to 1 billion in 2 days. IBIT got there in 4 days, and Fidelity got there in 5 days. So 3 out of the top 4 got to 1 billion assets. The fastest, and gold is in there too. So these type of assets, these hard assets, these commodity ETFs like this, they can rapidly grow. But this is huge, mind-boggling. I mean, at this rate, there's going to be so much diversification into Bitcoin. You know, conservatively, people were talking about 0.5% or something. I mean, if it keeps ripping like this, the actual volume and the actual inflows and the actual performance of the ETFs, I could see it going to 2% allocation to Bitcoin. Remember, Preston Pish, he had a comment the other day about if you have a 98% cash and 2% Bitcoin, which is also cash, but electronic cash, allocation in your portfolio, you outperform the S&P by a lot. So crazy. That's crazy. All right. Let's move on to the next tweet. And this is by Alistair Milne. And he says, the faster GBTC holders dump, the sooner this dip will be over. I think it's probably going to draw to a close, at least slow down dramatically. Reminds me of the bear whale selling 30,000 BTC on October 5th, 2014 for $300 each. He could have been a billionaire. Yeah, I think it would have been like 2 billion now, if my public math is correct. But let's go and watch the bear whale get slayed. I had an exchange account, and someone told me that I, from the Bitcoin meetup or whatever, hey, the bear whale is getting slayed right now or something. And so I jumped on. So I saw this live at the time. Pretty crazy. But he hasn't put in his big wall here. You'll see a big wall come down in the bottom here. There we go. Bam. 30,000 Bitcoins, pegging it to $300. Crazy. This was right before the scaling conflict really got kicked off. Someone was trying to obviously crash Bitcoin, take up all the buyers, but people just chewed through this. Let's zoom. Let's go a little forward. Still there, pegged right at 300. Can you imagine buying Bitcoin for $300 nowadays? Oh man. You'll see it break here and just shoot up in the chart up here. Still pegged 300, chewing through the wall. I probably should have muted that. All right, it's getting close. So GBTC is like the bear whale, just selling all their coin, and it's getting sucked up by the other ETFs. And when it breaks, look at that. Bam! I mean, within seconds. All right. So that's all I have for the Bitcoin stuff. Now let's go into um, more macro. And actually, I'm going to check the chat here real quick. Dex Invictus back with us. What's up, buddy? Okay. Telegram. See what you guys are talking about over here. What's the link to this clip? Which clip? The Fred one? I'll grab it, throw it in. I'll grab it and throw it in Telegram. Yep, there you go. Okay, ETF 10x the halving. But I don't think so. I mean, right now, yes. But that will wane. Reminds me of Willy Woo, sell pressure. Yeah. Of all ETFs, 0.25% of all ETFs. Yeah, thank you for that clarification. Okay, so that's it for that. Let's go into the macro stuff. And if you guys have been watching my content for a long time, maybe 2 years ago on FedWatch, I don't know if it was that long ago, but I think it was. I started talking about there's going to be a rise in piracy around the world because of the way deglobalization is going to progress. Okay. And I want to take a victory lap on this because now people are using this term widely. It's widely being talked about out there that piracy is on the rise and privateering, So these are pirates that are going to be working for governments. So privateers. And what that does, the reason for this rise is because the US is losing its willingness to enforce order. It's a subconscious thing. The US is naturally an isolationist type power because we are separated from the rest of the world by these mighty oceans. We are really a large island country. And so we tend to be more isolationist. We have everything we need here, all the raw resources, great arable land, oil, everything in abundance. And so we could be isolationist if we wanted to. And it was not until World War One, very end of World War One, we got in. That was unpopular for us to get in, but we did it. And then, of course, World War Two, it took Pearl Harbor and stuff to get us into that war. But ever since then, we have kind of managed the international system. But that's not our nature. Our nature is isolationist because of our geography. And so subconsciously, war is not popular, and so especially like these foreign wars, getting involved in foreign wars. So we are naturally going to just shift the cultural zeitgeist back towards isolationism, and we won't be protecting the sea lanes anymore. And what does that look like? Well, it looks exactly like what's going on in the Red Sea. Exactly. So let's read through this a little bit. What do you do as U.S. empire crumbles and global shipping goes back to a 19th century world of piracy? And also, I'll say this before I get into reading this, is that the U.S. has subsidized globalization by protecting the sea lanes, and at least maybe not physically protecting them, but our coalition, the international system that was supported by the United States, the UN, the WTO, all this stuff. That system is what guarded and protected the sea lanes. Now people they don't care about it. All those international institutions are breaking down. Anyway, so we subsidized this thing, and that makes globalization looks cheaper because you don't have to worry really for 75 years. You didn't have to worry if your ship was going to get attacked by pirates. But now, as the system breaks down, the cost of globalization goes up, and the burden has to be shared by other people. And pretty darn quickly, they're not going to like it. So globalization will continue to break down. All right, so decolonize economics. Markets started 2024 as wildly optimistic and wildly wrong about rates as they did in 2023. Is there something structurally wrong with economics or just them? After all, yesterday's US, okay, that's not talking about the pirates. Come on now. Where did they start talking about the pirates? Oh, man. Well, here we go. Let's think about the Suez Canal for a moment in that light. Who built it? Why was it built? Who fought wars to control it? Also note, the 1956 Suez Crisis showed the UK and France were no longer great powers with freedom to act geopolitically. Only the US and USSR were. And recall, Egypt shut the canal from 5 June 1967 until 5 June 1975, following the Six-Day War. Correlation is not causation. But what happened to global inflation at that time, even when Asia wasn't the world's factory? So yeah, a lot of this is going to cause prices to rise. And we need to break out reasons for prices rising. Okay, if globalization breaks down and the entire cost structure of the global economy rises by 5%, so prices rise by 5%. Is that due to inflation? No, it's not due to money printing. It's due to the breakdown of globalization. So we expect prices to perhaps continue higher, not immediately, but after this next recession, most likely, because of the cost structure of the global economy is going to rise. All right, so they didn't talk much about piracy, but let's go to the next one here. This is also from Zero Hedge, and it is about China's plunge protection team. So China's plunge protection. Wait, is this the one I want to go to first? No, let's go to this one. What on earth is going on with China stocks? Snowball derivatives knock in liquidations triggered. After the Hang Seng fell 3.7%, and the CSI 300 lost 2% on elevated turnover, Hong Kong volume was up 30% above the 50-day moving average, with flows heavily skewed to the sell side. The collapse in Chinese stocks is refusing to slow. And this morning, the brutal sell-off has picked up where it left off, pushing the Shanghai Composite below 2,800 to the lowest level since 2020 and effectively unchanged for the past decade. I mean, look at U.S. stock market hitting all-time highs. Look how far away the Shanghai stock market is from all-time highs back in 2015. I've also seen images of the comparison charts comparing the Japanese stock market over the last few months compared to the Chinese stock market, and they're totally opposite direction. People are fleeing out of China. This is another thing that I've been talking about for a long time. China's economic model is over. They're going to continue to have more and more problems. So they're having a bunch of strikes over there. 162 strikes in the country right now. Chinese authorities were said to be indicating to local fund managers to refrain from selling, okay, which has been used repeatedly, especially in recent months. So authoritarian, go out there, stop selling. They also, during COVID, remember, they banned short selling. I don't even know if it's back, but they banned short selling. So this is a change the rule type of environment. And when you're authoritarian regime, with your economic model being undermined more and more rapidly, you're going to change your rules more often. Needless to say, it tends to achieve just the opposite outcome of the intended one. More importantly, there are no expectations of major policy stimulus, which is clearly having very adverse impact on both economic and market sentiment at the time. All right. Resulting in a surge in labor strikes and protests. Said otherwise, it is only a matter of time before Beijing has no choice but to step in. And now let's go back to the other one. And that's what they have done. Apparently, China's plunge protection team buys billions in ETF to halt market rout. Of course, this is a play on the U.S. plunge protection team, which does exist. It was a economic council put together by Ronald Reagan. It's well documented. There is such thing as plunge protection team. How much they actually go out in the market, that's where we don't know for sure. Once again, TradFi is not transparent. Last night, we warned that as a result of the ongoing rout in Chinese capital markets, the CSI 1000 index has tumbled just shy of the key 5180 level, which could knock in, i.e., trigger over 30 billion yuan or $4.2 billion in snowball derivatives products tied to the index, which would in turn unleash a selling cascade and could spark a wholesale market crash. I mean, look at that. That's nasty, man. Nasty. Okay. Well, come on, man. Well, it seems that Beijing also read the warning because just minutes later, Chinese equity indexes rebounded furiously in afternoon trading with a volume explosion in some major ETFs, a hallmark of aggressive buying by state funds, i.e. China's plunge protection team, who stepped in to halt the slide. As shown in the chart below, the total traded value of the CSI 300 ETF surged to 15.3 billion yuan on Thursday, and the highest since 2015 as the national team made its presence known. All right. That coincided with gains in the CSI 300 benchmark of mainland shares, which closed 1.4% higher after declining as much as 1.8%. But they had to continue doing this, Nothing is going to get fixed by the plunge protection team. They're just going to avoid that liquidation level a little longer. That's all. During previous market slumps, state funds were suspected to be behind surges in turnover of such ETFs as they stepped in to rescue the market. For instance, Central Haijin Investment Limited, a sovereign wealth fund, bought an undisclosed amount of ETFs in October and vowed to keep increasing its holdings. The national team is likely stepping in to stabilize the market as they have done in previous market crashes. Strategists from Bloomberg. And as Beijing bought, foreign investors were again aggressive sellers of mainland stocks after they dumped 13 billion yuan worth of shares in the previous session, the most in more than a year. So yeah, foreign investors are getting out. And remember, China was built on foreign direct investment. They were trying to attract funds, but this is going to chase more and more investors away. They see what's happening, not only with it crashing, but with having to come in and rescue the market like this. This does not look like a place that you want to keep your money. Look at the U.S. stock market. It's at hitting all-time highs, and this is happening in China. The Bitcoin ETFs just launched, and this is happening in China. I mean, you're going to put your money elsewhere. And what happens? Foreign direct investment turns negative. You have capital flight out of China, and you have a massive recession. China's economic model is over. Okay. What is next? Let's take a look at the Empire State Manufacturing Survey. This is put out by the New York Federal Reserve. I know I'm kind of all over the place here, guys, today, but there was a few odds and ends that I wanted to get into the same show. So this is the Empire State Manufacturing Survey, and my God, it was a complete disaster. So let's see how much I can zoom in on this. All right. So look at that collapse. Worst since COVID, worse than the Great Financial Crisis. So we are in a bigger contraction of general business conditions than we were at the lows in the Great Financial Crisis. Let that sink in. All of these statistics coming out from the Fed are all showing massive, massive declines. This is what Powell's looking at. This is a complete disaster in the economy. So what does this mean? We're going to go into recession. Soft landing is probably not going to happen. We're going to go into recession this year. And so what do when we go into recession? Well, we have the pre-recession period, which is what we're in right now. And the pre-recession period is dominated by gains in stocks and bonds and Bitcoin. So we're going to have a bull market in stocks, bull market in bonds, and a bull market in Bitcoin until now, when the recession starts. When does the actual beginning of the recession force the stock market down? That's the one time this year that I'm kind of worried for Bitcoin, actually. We'll probably get through the halving, get a few months into Q3, or a couple months into Q3, and then we're going to have some sort of market crash, maybe around the end of Q3. Remember the seasonality, that's big for me. So that's what I would be watching. But the first 6 months of the year should be extremely bullish for stocks, bonds, and Bitcoin. But the reason why I show this Empire Fed thing is to just say that we are more and more confident every day that we're actually going into recession this year. And also, I wanted to juxtapose this with the numbers coming out of the administration on the political side. A lot of people say, oh, Powell is the reason why he's talking pivot now is because Biden, because the White House is putting pressure on him. That's not the reason. This is the reason. This is the reason right here, or one of them. They see that the economy is deteriorating rapidly. So the statistics that we see out there that aren't showing recession are all coming from the administration, from the government, not from the Federal Reserve. The Federal Reserve is showing recession. So, and remember, who dictates whether we're in a recession? It's not the Federal Reserve. They don't say we're in a recession. It's the National Bureau of Economic Research, a government agency. So I just wanted to point out the mismatch between the Fed and government numbers, even though the Fed is quasi-government. Okay, so that is going to do it for today, guys. Thank you for joining me. My name is Ansel Lindner. Bitcoin and Markets. Check out bitcoinandmarkets.com. I'm going to take a look at the chat. I miss FedWatch. Oh, thanks, man. Yeah. They decided to go the other way, but I am writing now for BM Pro, or Bitcoin Magazine Pro. So check that out if you haven't. I heard a doggo in the background. Oh, sorry. Yeah, we're watching a neighbor's dog right now. The kids are dog sitting. That's kind of the 12-year-old job. FedWatch was just answering with background noise. No, man, CK was great. He's still one of my good friends in Bitcoin, and hope he is doing well. You know, he went away from Bitcoin Magazine for a better work-life balance, as far as I understand, and now he's doing really good work, and hopefully he gets that good work-life balance. Yeah, Nolan, I got to reach out to Nolan, see what's up about this conference. If I'm going to be going to the conference, I don't even know that yet. So I will have to contact Nolan and see, maybe I can do something, either work there or I would like to lead a panel like in one of the side rooms. That'd be pretty cool, but don't know. CK still isn't bullish enough. I mean, we're all pretty bullish, and that's, man, this week I was talking with guys over in Telegram, and it is hard this week was hard to stay motivated because the price was dipping. You know, the ETF, the adrenaline from the ETF launch was worn off, and price was dipping, and it was just really hard to stay motivated. So that's why I didn't live stream on Wednesday, but I put my head down and I wrote a bit. Actually, let's do that. Let's take a look at this business cycle post. Again, this is for paid members right now on the website, but it will go out publicly for you guys to read it. But so I talk about this chart he has, and you know, he's talking about credit. The expansion of credit will cause the boom bust cycle, you know, the business cycle, the Austrian business cycle. And his whole thing of his post, Tour de Meester, his paper, is calling that fraud, because he calls fraud. Let me go down there. He specifically calls it It's like 2,500 words, I think, on this post. Where is it, man? Here we go. Deception of a kind that inherently and inevitably leads to conflict, crisis, and social chaos. So that's what circulation credit does. Anyway, let me read some of this. So first off, I make the point that Austrians do not deal with credit-based money. They deal with credit money. I mean, Mises has a whole section of, a chapter on credit money. And I took out some quotes from that. This is about as much as he describes credit money. And I'm not kidding. We may give the name commodity money to the sort of money that is at the same time a commercial commodity, and the name fiat money to money that comprises things with a special legal quality. A third category may be called credit money, this being that sort of money which constitutes a claim against any physical or legal person. And then the end of that chapter, this is the last sentence. Credit money, finally, is a claim falling due in the future that is used as a general medium of exchange. That is it. That's all Mises says. I Googled and Googled for Rothbard stuff. Couldn't find him talking about it. But what's it a claim on? A claim falling due. A claim of what? To what? It's a claim to the commodity money. So credit money, according to Mises, as far as I can tell, he does not believe in pure credit-based money, and that's what we have today. He spends half the book talking about fiduciary media, which is a related topic. However, fiduciary media is necessarily defined as a money substitute in relation to sound money. So fiduciary media cannot exist on its own, according to Mises. It always is defined in relation to commodity money. That's part of his definition. And here's his little, let's see if I can open this up. I can't get it. Let me zoom in. I don't know why some images don't open up in my website, but so money in the broader sense, that this is the whole thing up top, then money in a narrower sense. You see credit money right here next to fiat money and commodity money. Fiduciary media is over here on a whole different side. It's a money substitute. But a money substitute is always in relation to the money. It's never just on its own, like what we have today. So the Austrians do not cover this well. Guido Holzman has a section on the ethics of money production. This is an incredibly good book. It's free if you want to go out and check it out. I've linked to it in this post. But yeah, I recommend this is mandatory reading. So human action and the theory of money and credit, those things are really, really long and dry and stuff. But the ethics of money production by Guido Holzman is mandatory reading, I think, for anybody that wants to know about money and stuff like that. However, he doesn't talk about credit money or the kind of credit-based money that we have today. He does talk about credit money. I think it's like chapter 4, section 4 in the book. He has a few pages about credit money, but this is to sum up what he has to say. Credit money is only a derived kind of money. It receives its value from an expected future redemption into some commodity. So once again, in relation to commodity money. But that contradicts this. So he's pretty much saying expected future redemption. So that's like a money substitute or a money certificate. So Guido is putting credit money over on the right side of that diagram, not over here where Mises put it. But Mises doesn't describe what it is, and no Austrians do, as far as I know. So I said, perhaps reactions to this post will bring some to my attention, but I don't know of any. So Austrian and the business cycle cannot describe what we're going through right now because they don't understand credit-based money. So, okay, let's see. What else can I talk about real quick? Again, this will be public probably this weekend. Okay, so this is Tour uses Huerta de Soto's description of how a business cycle occurs. And I break this down. This is an interesting section, so let's go through it. I kind of cut it up here so I can comment on it, but here we go. The increased supply of loans, which results from credit expansion, will initially exert an effect very similar to that produced by the flow of new loans from savings. Okay. I say the increased supply of loans does not cause credit expansion. They are the same thing. Increased supply of loans is credit expansion. Credit expansion results from an increased demand for loans and an increased willingness to lend. This is a critical mistake. DeSoto is making a critical mistake, very, very critical mistake, because it mixes up all the arguments that flow from it. Like the rest of that sentence, the order of operation is wrong. So this is what he's saying. This is how it works. Credit expansion, increased supply of loans leads to some effect in the economy. Instead, it is a change in the market that creates a change in the demand for loans, resulting in credit expansion. The credit expansion is the result, not the primary mover. Okay, so DeSoto goes on. It will tend to cause a widening and lengthening of the stages in the productive structure. Okay, I don't talk about that. That's important. Tour talks about it in his post, so you guys can go read that if you'd like. The relative reduction. Okay, this always throws me for a loop when I read this. Okay, I think there's a comma missing. That's why. The relative reduction credit expansion causes is the interest rate boosts the present value of capital goods. Since the flow of rents, they are expected to produce increases in value when discounted using a lower market rate of interest. Okay. This is all mixed up, completely mixed up, because they start from a backwards argument. So here, DeSoto adds to the chain of events. Credit expansion causes a reduction in the interest rate. In other words, credit expansion increases the supply of credit relative to demand. So does that make sense? So they're saying that the supply of credit, the number of loans, rises faster than the demand for loans. That's why interest rates go down. But how can the supply of a loan rise faster than the person taking out a loan? You might know what I'm about to say. This is plain wrong. Interest rates objectively rise in a growing economy because 1, returns on investment rise, and 2, there is more demand for credit from both borrowers and lenders. Interest rates fall as returns on investment fall, and borrowers and lenders become more hesitant. If interest rates are falling, real expected rents are falling, not rising. It is exactly what causes interest rates to fall. Okay, then he goes on to this next section. This is the last part of DeSoto here. In addition, the lowering of the interest rate gives the appearance of profitability to investment projects, which until that point were not profitable, giving rise to new stages further from consumption, i.e., stages which are more capital intensive. In short, entrepreneurs decide to launch new investment projects, widening and lengthening the capital goods stages in the productive structure. That is, they act as if society's savings had increased, when in fact such an event has not occurred. This triggers the process of maladjustment and discoordination in the behavior of the different economic agents. In a nutshell, this is an inducement of mass entrepreneurial error in economic calculation. All right, that's a lot. So how do I break this down? So now we can see the culmination of getting the first part wrong, the first order wrong. He's trying to place interest rates in front of the appearance of profitability in a sequence. So here he says that interest rates, lowering of interest rates, creates the appearance of profitability. So interest rates go down. Now there's appearance of profitability in projects that weren't profitable before. Okay? When in reality, interest rates are falling because the lack of profitability. It's completely backwards. For DeSoto's explanation to be correct, it requires credit expansion, that's a supply increase, prior to demand for credit. We must believe the inverse, I say reverse, but inverse of typical supply and demand dynamics, that higher demand for credit forces the cost of credit down prior to supply increasing. So why, as interest rates go down, that is a cost to the borrower, right? That should go down as let me get that sentence again. The higher demand for credit forces the cost of credit down, but the cost of credit should go up, because in supply and demand, if demand rises and the supply stays the same, price should rise, right? But here they want us to believe that demand rises and the cost of credit goes down. That's not how supply and demand works. We also have to believe that less profitable uses of capital incents higher supply. So why would bankers, they see out there in the economy, there's less profitable uses out there in the economy. So why would they want to lend more? They would actually want to lend less. Supply would actually be cut. So in other words, we must believe, for this to be correct about the business cycle, we must believe mass entrepreneurial error is caused by a false signal they have yet to create. I mean, that's a dagger right there. The false signal incentivizing demand for credit does not come from lower interest rates. Falling demand for credit is the signal. And those two sentences actually took me a long time to figure out. If you guys would have seen me writing last night, I was like, oh my gosh, this is, how do I say this? And I don't even know if it's exactly makes sense right now, but it makes sense in my head. So let me say this again. In other words, we must believe mass entrepreneurial error is caused by a false signal they have yet to create. So more expansion of credit happens when people take out a loan. You can't have credit expansion, going back up here. Where do I say this? You can't have credit expansion sorry, I was trying to figure out what I was trying to say there. Credit expansion increases the supply of credit relative to demand. But how? Because supply is equal to demand. You can't increase credit without giving a loan, and you won't take out a loan if there's no demand. See the problem? So these people want you to believe that credit expands before credit expands. I can't square that. Okay, so that was fun. But I do have a kind of a cool solution down here. I bring in some evolutionary thought. I bring in talking about fiduciary media as fraud, which is what Tour calls it, and how we see fraud fraud is in this way a deception. What he's calling it is everywhere in nature. It's a natural part of the market. And yes, we should try to eliminate some as fraud as much as we can to a degree, right? But banning fiduciary media, banning circulation credit is a monster step. That is a massive, massive step. And I don't think it will ever happen. It will never happen. So anyway, so check that out, guys. All right, I'm going to see the chat. See where we're at on the chat. And then we got to get going here. Or I got to get going. Back to CK. Yeah. Do you have anything to add? No. Well, he did. I mean, he was the Bitcoiner, and I was kind of more of the wonky character on FedWatch, and that was it was a good dynamic. I thought I liked CK and my dynamic better than with Nolan, because I felt like I didn't let Nolan talk because he's a talker and I'm a talker, and I felt like I wasn't letting Nolan talk enough when I got going. Did I look at Natalie Smoletsky? Her argument about commodity money versus credit money for origin of monies. Her name does not ring a bell, but I'm pretty familiar with the different theories on how money was created. And I have some thoughts on that. Like it's about scale and it's about trust. In places that were geographically more prone to long distance trade, like places around the Mediterranean, places along rivers and from the Baltic, down into Russia and the Ukraine area today and into the Black Sea, and places anyway that had long distance trade, they would not use credit money. Mostly they would use hard money. But places that were insulated, places that had smaller economies that didn't do very well, then they could use credit money. And but the use of a valuable object as a store of value goes back before we were humans. I mean, they found a place in Eastern Africa that was like an obsidian mine where they would break off obsidian and make little, arrowheads or whatever out of it. And that goes back to like before we were humans, I think. And they found it being traded hundreds of miles away. So yeah, they humans have used money or a form of money forever. And I think animals might as well. They one of the examples from Nick Szabo was that altruistic, what's it called? Altruistic kinship or something like that, where bats will actually share food with their family members in the cave and stuff. So the biggest commodity for bats is blood, say, or whatever their food is. And so then they will share that like with their kin group, right? So there is a very, very rudimentary sort of market, even amongst animals. And since humans are just more advanced animals, of course, we have been using money forever. So anyway, I could talk about that for a long time. Okay, so she agrees with me. Okay, I'll check her out. All right, how many guys we got in here? 9 people watching. All right, let's get those numbers up. Like, comment, subscribe. Let me see what the Telegram folks are saying. No comments from Telegram. All right, guys. Well, I'm going to cut it off there. Thanks for hanging out on this Friday. I hope you guys have a great weekend. Get out and get some sunlight. It's deep winter, and I know there's a lot of vitamin D deficiencies. So make sure you're getting your daily dose of sun. Getting outside, spend time with friends and family. That's what's really important. I mean, knowing about how many inflows and outflows of the Bitcoin ETFs is not really important compared to spending quality time with friends and family. So thank you for hanging out with me, and I will see you guys on the next one. Bye.